Stop whatever you're doing right now. Seriously, close the other tabs, set your phone down. What I'm about to share with you is not a theory. It's not a guess. It's not another prediction about a possible future scenario. At exactly 3:47 a.m. Eastern this morning, one of the largest market makers on Wall Street halted all silver price quoting, not just for retail investors, not just for smaller institutional clients, for everyone, for the entire interbank network. This is the most advanced, most powerful, most well-connected trading desk in the precious metals world, the desk other banks rely on when they need a real price. The same desk that handles billions of dollars in metals trades each and every day. That desk, it just went dark. And I have the alert, the actual internal notice that was sent out at 3:47 a.m. to all of their trading partners. And once you read it once, you truly understand what it means. You'll realize that what happened today isn't just important, it's seismic. This was the moment when the sharpest minds in finance stared at their monitors, ran the models, and came to one simple conclusion: they can no longer price silver. They cannot determine its value. Their algorithms failed. Their risk systems malfunctioned. And instead of continuing to operate blindly in a market they no longer grasp, they simply opted out. Let me show you exactly what occurred. I'll break down the full timeline for you. I'll explain why this specific moment, this 3:47 a.m. notification, is the most significant signal in the precious metals space since 1980. And I'll walk you through what you must do within the next 24 to 48 hours if you want to position yourself on the winning side of what comes next. Because what's approaching is not some slow price shift. It's not a well-managed correction. It's a complete breakdown of the paper silver market and a vertical surge in the value of physical silver that will draw a stark line between those holding real metal and those holding nothing but empty promises. The blink just happened. That trading desk blinked. And when the dominant player in the market admits they can no longer participate, everyone else had better pay close attention. But before I show you the alert itself and before I take you through the math that broke their system, you need to grasp what it means when this institution stops offering prices. Most people don't truly understand their role in the silver market. They assume it's just another big bank, just another trading entity. That's a child's view. This firm isn't just part of the silver market, they are the silver market. They are the primary price maker. Let me explain. When an institution anywhere in the world wants to buy or sell silver, they don't just call random banks and hope for a bid. They reach out to this desk first, because this institution always has a price. They consistently maintain a bid and an ask. That's the core of their business model, the very reason they exist in the commodities sector. They supply liquidity, they create the market. Here's how it works. Let's say you're a major bank like JP Morgan and a client wants to offload 10 million ounces of silver. You pick up the phone and call the market maker. You ask, what's your bid for 10 million ounces? Their trading desk scans the data, the COMEX futures price, the current physical silver quotes from London, Zurich, and Singapore. They assess their existing inventory, check their hedge positions, and within moments they give you a number. We'll buy 10 million ounces at $71.40 per ounce, valid for the next 30 seconds. That's the bid. If you act quickly enough and confirm the trade within that 30-second window, they are contractually bound to fulfill it. They take on the full 10 million ounces at 71.4. Immediately they head to the COMEX or OTC market and hedge that exposure. They might sell futures. They might initiate swap contracts. They'll do whatever is needed to eliminate risk, and they profit on the spread. Perhaps they buy from you at 71.4 and hedge at 71.5. That 10-cent difference on 10 million ounces translates into $1 million earned in half a minute. That's what market making is all about. And they repeat this process thousands of times every day across commodities, currencies, and other instruments. They're always quoting, always transacting, because each trade earns a margin and each margin builds profit. This continuous quoting is the foundation of their revenue stream. They generate billions annually simply from capturing spreads on the countless trades they facilitate. So when they suddenly stop quoting when they refuse to give a price, it's never arbitrary. It's not routine risk adjustment. It's a loud, clear signal that the market has grown so chaotic, so unmanageable, so dangerous that it's no longer viable to participate. The risk becomes too high. The danger of quoting an inaccurate price. The exposure from buying at 71.4 and not being able to hedge at 71.5. The nightmare of being stuck with a massive unprotected position that could produce catastrophic losses. That's when the risk outweighs the reward. And when this firm makes the call to abandon billions in annual spread income, you better believe the situation is dire. Let me show you the message. I received it at 4:23 a.m. from a trusted contact working on an institutional trading floor at a top-tier bank. He forwarded the notification that had been sent out at 3:47 a.m. to all counterparties. Here's the exact wording. Global Commodities Trading Desk. Effective immediately 3:47 a.m. EST, the 12th of January 2022. We are temporarily unable to offer quotes for silver spot forward swaps or options. This pause applies across all silver-related products and all trading partners. Recent market activity has moved beyond the scope of our automated risk controls. We are urgently reviewing our pricing systems and will resume quoting once we are confident in our ability to provide reliable and executable prices. There is currently no estimated time for resumption. For urgent matters, contact your relationship representative. Please note, no quotes will be provided, including on a discretionary basis, until our review is complete. Read that line again. Market activity has moved beyond the scope of our automated risk controls. What does that imply? It means the firm's algorithmic pricing systems advanced platforms built to calculate bid, ask spreads in real time using vast market data encountered conditions they couldn't process. They were unable to generate a viable price. The math failed. And when the calculations fail, when your risk engine returns an error rather than a price, you're out of options. You have to pull back. Trading without a firm grasp on your risk exposure is financial suicide. And while this institution is aggressive, it's not reckless. They saw the system fail. They understood the consequences. And they shut everything down right at 3:47 a.m. Now I need to walk you through exactly what caused the collapse. The very calculation that overwhelmed the system. Because once you see it for yourself, when you understand the scenario they faced, it becomes clear this isn't just a blip. This isn't a short-term issue. This is a full-scale breakdown in the architecture of the silver market. And it started early this morning. The pricing algorithm they use relies on 3 core data inputs. First input, the COMEX futures price, the benchmark paper value of silver, traded on the Chicago Mercantile Exchange. As of the prior Friday's close, this was pegged at $71.30. That's the starting figure the algorithm references. Second input, the real-world price of physical silver pulled from key global markets like London's OTC exchange, Zurich trading floors, and vaults in Singapore. The system ingests this live market data continuously. And as of 3:47 a.m., here's what the physical markets were showing. London was showing $128 per ounce for 1,000-ounce bars. Zurich was at $132 for 100-ounce bars. Singapore was trading at $135. Average those 3 key physical hubs and you get roughly $132 per ounce. So now look at the gap COMEX at 71 physical at 132. That is a $61 difference, an 86% premium. In other words, physical silver was trading at about 186% of the paper price. Now we move to input 3, liquidity depth. This measures how much silver can actually be bought or sold at quoted prices without materially moving the market. In a healthy liquid market, you should be able to transact tens of millions of ounces with minimal price impact, but at that moment liquidity had evaporated. The physical markets feeding into the algorithm were flashing bid-ask spreads of $20 to $30. In London, for example, bids were around $128 while offers were closer to $155. That's a $27 spread on an asset priced near $140, roughly a 19% bid-ask spread. In normal precious metals, trading spreads are measured in cents, maybe $1 during extreme stress. A 19% spread is not stress, it is dysfunction. It signals a market with almost no committed buyers and almost no committed sellers, a market that for all practical purposes has stopped working. This is where the real problem emerges. The pricing system is built to take these 3 inputs and generate a bid and an ask that allow market making without unacceptable risk. It relies on historical guardrails. For example, if the physical paper gap exceeds 20%, the system widens spreads to around 5% to compensate for arbitrage risk. If liquidity metrics deteriorate, spreads widen further. That framework has worked for decades. It survived the 2008 financial crisis. It handled flash crashes. It navigated every major dislocation in modern markets. But at 3:47 a.m. today, the system encountered conditions. It had never been designed to face conditions that violated every safeguard built into it. Here's the math. Physical silver at 132, paper at 71. That's an 86% divergence. The maximum tolerance coded into the system for physical paper separation is 40%. Beyond that point, the algorithm has no rules. It cannot determine a safe price. It simply fails and returns an error. And it doesn't stop there. Liquidity indicators were showing 19% bid-ask spreads in the physical market. The system is programmed to shut down quoting once those spreads exceed 10%. Above that level, arbitrage becomes impossible and hedging breaks down. Exposure to slippage becomes extreme. 19% blows straight through that limit. Another error. Then comes volume. The model also requires a minimum level of trading activity to confirm that prices are real and executable. At 3:47 a.m., overnight volume in the London OTC silver market was just 94,000 ounces. That's just 10% of the typical overnight volume. The algorithm's baseline requirement is 500,000 ounces. Anything below that and the system flags the market as too shallow, too unstable, and the price data becomes unreliable. 94,000 ounces, instant error. That's 3 strikes. Every critical input is outside the acceptable range. Physical to paper spread 86%, while the limit is 40% error. Bid-ask spread in physical markets, 19% cap is 10% error. Volume 94000 ounces, floor is 500000 error. The system received 3 simultaneous critical failures. When all primary indicators flash red, the algorithm has no alternative. It cannot generate a reliable quote. It shuts itself down. And that's exactly what happened at 3:47 a.m. But here's where it goes from serious to system-wide. It wasn't just this one firm. Within hours of the alert being sent, the rest of the financial community began to react. Let me walk you through how it unfolded, the chain reaction from 3:47 a.m. to the 9:30 a.m. U.S. Market open, 3:47 a.m. The alert goes out, quoting in silver is suspended. Around 200 counterparties receive the message. That includes virtually every major investment bank, hedge fund, and institutional trader involved in the metals market. 4:15 a.m. JP Morgan's silver desk comes online. They see the notice and immediately reach out to their contact. What's happening? When will quotes resume? The last quoted bid was $58. The ask was $94, a $36 gap. That's not price discovery. That's a distress signal. At 9:30 a.m., the COMEX opens for regular trading. Chaos erupts immediately. The first February futures contract prints at $82, up $11 from Friday's close of $71. Just 3 seconds later, the next trade prints at $67, down $4 from the same benchmark, then $89, then $73. Prices are swinging violently because liquidity is non-existent. With no major players providing consistent two-sided pricing, only panicked buyers and sellers remain. Every tick is driven by the most desperate trader at that instant, and the price action is completely erratic. By 9:45, the COMEX halts silver futures, triggering a volatility pause. Trading is set to resume in 15 minutes. It's a temporary breather intended to calm the market, but it doesn't help. At 1:000 a.m., trading restarts. The first transaction prints at $97, then $59, then a shocking $14. The market is in full-blown disarray. By 1:030 a.m., the COMEX pulls the plug entirely, halting all silver trading for the rest of the day. Due to extreme price fluctuations and an inability to maintain orderly trading, silver futures are suspended until further notice. That was the domino effect. The 6-hour chain of events that began with a 3:47 a.m. alert and ended with the complete shutdown of the paper silver market. In just 6 hours, the infrastructure collapsed. Because once market makers exited once, Goldman and the other institutional desks stopped quoting, the system lost its foundation. No quotes means no price. No price means no market. Only chaos. And in that chaos, the exchange had no alternative but to stop everything. Now here's why this isn't just another market scare, some might say. This has happened before. Temporary disruptions. Banks pull back. Exchanges pause trading. It's nothing new. But that's a misread. This isn't a temporary glitch. This is something entirely different. This is not ordinary volatility. It's a structural collapse. And here's how we know. In previous silver market swings, like in 2011, the cause was a demand imbalance. Prices spiked from $30 to $50 due to massive speculative buying. Too many longs, not enough shorts. Volatility surged. But the market makers remained. The big desks kept quoting. Yes, spreads widened, but the system still functioned. Or take 1,980 when the Hunt brothers attempted to corner silver. Prices soared to $50. The surge was driven by outsized demand from a single player. But even then, quotes were available. There was still liquidity. The COMEX eventually stepped in to alter margin rules and limit the hunts, but throughout the run-up, the exchange still operated. The market remained intact. The response? There's no set timeline. The disconnect between physical and paper is too extreme. We can't establish pricing. We're out until further notice. JP Morgan's team reviews their own data. It's identical physical at 132 futures at 71, an 86% disparity. Their risk management division makes the call. If they can't quote safely, neither can we. JP Morgan halts silver pricing at 4:38 a.m. 511A. Citi's London operation logs in. They've received alerts from both firms. They check local market conditions. Spreads are no longer $27, they've widened to $32. Liquidity is deteriorating by the minute. With two major players stepping back, the market is freezing. Citi joins them and suspends pricing at 511A. 6:42 a.m. Bank of America, Morgan Stanley, and two large European banks halt silver market making within minutes of each other. By 7:00 a.m., 7 of the 12 largest players in the global silver market are no longer quoting. By 8:00 a.m., the count is 10 out of 12. By 9:00 a.m., before U.S. equities even open 11 out of 12, top-tier banks have withdrawn from quoting silver. The last one standing is a small regional institution without the sophisticated modeling tools or real-time risk infrastructure the others have, and their bid-ask spreads are so wide they're effectively unusable. There used to be a functioning market, but what unfolded this morning was unlike anything we've ever seen. The market makers didn't withdraw because of an overwhelming surge in buying or an avalanche of selling. They stepped aside because they couldn't price the asset. They saw COMEX futures quoting $71 and London spot at $132, and their systems effectively threw up their hands. Error. Spread cannot be resolved. They couldn't reconcile the discrepancy. They couldn't find a bid-ask spread that made sense, so they didn't try. They stopped quoting entirely. This is unprecedented in modern silver trading. Yes, we've seen wild price swings before. Yes, we've seen illiquid days. But never, not once, have we seen a scenario where the core institutions, the ones built to provide liquidity, looked at the data and said, we're done. We can't participate. We don't even understand what we're seeing. And here's what's most alarming. This isn't a temporary problem. Goldman isn't going to flick a switch tomorrow morning and resume pricing. The breakdown that destroyed their algorithm, an 86% spread between paper and physical, hasn't improved. It's deteriorating. Let's look at the current numbers. As I speak early afternoon, January 12th, the COMEX remains shut down. No paper trades. But physical silver is still moving. Here are the live prices. London, $142. Zurich, $147. Singapore, $153. New York physical dealers, the ones that hand you the metal if you pay cash, are quoting $158. The global average for physical silver is around $150. The last COMEX price before the halt this morning, $14. Yes, $14. Granted, it came from a dysfunctional, chaotic tape, but even if you compare to Friday's more stable close of 71, the current spread is now $79. That's a 111% premium. Physical silver is trading at more than double the paper price. And the gap is not narrowing. It's growing because while the futures market is frozen, unable to function, the physical market is still operating based on real-world supply and demand. And as long as that dislocation remains, as long as physical and paper are on separate planets, no major market maker can step in. Goldman's algorithm can't deal with it. Neither can JP Morgan's. Neither can any desk. So the professionals are staying out. The paper market remains locked. And the only price that matters now is in the physical realm, where silver is at $150 and rising. Now let's talk about what this means for the COMEX delivery mechanism. This is where the true crisis is developing. The entire point of a COMEX futures contract is its convertibility. When you buy a contract and hold it through expiry, you have the right to take delivery. The clearinghouse member who sold it to you is obligated to provide the actual silver. That convertibility, the ability to swap paper contracts for real metal, is the glue that ties the futures market to the physical one. It's the core arbitrage mechanism. If paper silver is trading at $70 and physical silver is at $130, a trader can buy the paper stand for delivery, take possession of the metal, and sell it into the physical market at $130. That trade narrows the gap, futures rise, physical prices soften, and both markets find equilibrium. But what happens when market makers vanish? What happens when firms like Goldman, JP Morgan, Citi, and every other major player refuse to facilitate paper trades? The arbitrage breaks. It simply stops working, because you cannot buy a futures contract if nobody is quoting it. No entry means no arbitrage. And without arbitrage, there's no price convergence. The two markets, paper and physical, continue drifting apart. And that's exactly what's unfolding right now. But it gets worse. Even if you already hold COMEX futures, even if you purchased them last week while the market was still active and you now want to take delivery, you're going to run into a major roadblock. Why? Because the entities obligated to deliver that silver, the clearing members, are the same institutions that have stopped quoting altogether: Goldman, JP Morgan, Citi. If they can't safely quote prices, do you really think they'll deliver actual metal? To do that, they'd have to go source silver. If they're out of inventory, they have to purchase it from the physical market where the going rate is $150. To cover contracts they sold to you for $71. That's a $79 per ounce loss. On a standard 10-contract position, which equates to 5,000 ounces, that's $3.95 million in losses. And when you multiply that across the number of outstanding contracts and delivery demands, you're talking about potentially hundreds of millions or even billions in realized losses. That's not going to happen. No bank is going to eat that kind of loss willingly. So what are they going to do? They'll either default or they'll pressure the COMEX to invoke force majeure and convert everything to cash settlement. And when that happens, when the exchange announces, sorry, no physical delivery, here's a check, instead it's game over, the disconnect between paper and physical isn't temporary anymore. It's permanent. The futures market becomes a synthetic game, a Vegas-style betting pool. Contracts are settled in fiat and nobody ever touches actual metal. Meanwhile, the physical market becomes the only place where real silver trades hands. And without futures to suppress the price, the physical silver price explodes completely uncapped. So let's talk about what happens next. There are three possible paths forward, and we are now standing at the crossroads. What comes next will determine whether this is a short-lived shakeup or a fundamental restructuring of the entire market. Scenario 1. Scenario 1 is the everything goes back to normal outcome. The exchange and the banks somehow manage to restore standard operations. Quoting resumes, trading restarts, deliveries are honored, the market moves on as if nothing ever happened. For that to occur, the gap between physical and paper prices must close. Either physical prices fall or paper prices rise until they converge somewhere in the middle. Let's assume they meet at $90. Physical silver drops from 150 to 90. Paper silver climbs from 71 to 90. The spread disappears, the algorithms are satisfied, quotes return, markets reopen, crisis resolved. What are the odds of that? In my view, less than 5%. For physical silver to fall from 150 to 90 would require either a sudden flood of new supply or a sharp collapse in demand. Neither is happening. Supply is tight. Refineries are running at capacity. Dealers are sold out. Demand is increasing, not weakening. Retail investors are rushing in. Industrial buyers are stockpiling. Large sovereign entities are accumulating. The physical market is not rolling over. On the other side, for paper prices to rise from 71 to 90, short positions would need to cover and buyers would need to push prices higher. But shorts cannot close positions if trading is frozen. If there are no quotes and the exchange is halted, they're stuck. They have no exit. And even if trading does resume, there's no guarantee prices move higher. Panic selling from longs could just as easily push prices down. So scenario 1, the clean reset where everything returns to normal, is effectively off the table. The market is broken and it's not snapping back together. Scenario 2 is far more likely. The exchange declares force majeure. Emergency clauses are triggered. Officials announce that due to extreme market conditions, all outstanding futures contracts will be settled in cash at a price set by the exchange. Physical delivery is canceled. Everyone gets paid in dollars instead of metal. At what price? Most likely some reference average, perhaps the mean, of the 5 trading days prior to the emergency declaration. Let's say that figure comes out around $75. That's what longs receive per ounce in cash. But physical silver is trading at $150. That means longs lose $75 per ounce. They believed they owned silver. Instead, they receive half its real-world value in cash. Meanwhile, the shorts win. They sold silver around 71 and were staring down the possibility of buying it back at 150 to meet delivery obligations. Now they're relieved. They only owe 75 in cash instead of delivering physical metal. They save $75 per ounce. This outcome is highly likely. I'd assign it a 60 to 70% probability. It shields the institutions. It protects clearing members. It prevents the banks from absorbing catastrophic losses. And it sacrifices retail investors who were long silver expecting delivery. But the system isn't designed to protect retail participants. It's designed to protect itself. The system is built to protect itself, and force majeure is the tool it uses to do that. We've witnessed this kind of maneuver before. Back in 2022, the London Metal Exchange did exactly this with nickel. The price surged. Some traders were positioned perfectly on the verge of booking billions in profit. The LME stepped in and said, "Nope, those trades are void. We're reversing them." The traders who were about to win got nothing. The institutions that stood to lose, they were saved. The exact same playbook is about to be used in silver. Emergency declaration, cash payouts. Paper longs lose, paper shorts win, and from that moment forward, the paper and physical silver markets go their separate ways for good. Scenario 3, the slow kill managed chaos. The COMEX doesn't announce a formal force majeure. Instead, they implement a sequence of policy changes that effectively dismantle the paper silver market. They could impose tight caps on position sizes. They could jack up margin requirements to absurd levels. They might ban most participants from standing for delivery, or more dramatically, they could shift silver futures to be entirely cash settled just like stock index futures. You can trade them, you can bet on price movements, but you'll never be able to take delivery of real metal. All of these moves have the same goal: disconnect the futures market from the physical market, turn COMEX silver contracts into synthetic numbers price bets with zero connection to actual silver. And when that disconnection is complete, the price on COMEX no longer matters. Whether it's trading at $70, $85, or $100 is irrelevant. You can't redeem your contracts for metal. So the only price that counts is the physical one, and that's $150 and climbing. I'd assign a 25-30% chance to this third scenario. It's less probable than outright force majeure, but more likely than everything magically returning to normal. And at the end of the day, it leads to the same result as scenario 2, the death of the paper market and the rise of the physical market as the true price discovery mechanism. Across all three outcomes, one conclusion is constant physical silver wins. If you're holding real silver in your hands, not on paper, you're safe. Your wealth is tied to the physical market where buyers are still bidding higher. But if your exposure is paper COMEX futures, SLV shares, unallocated bullion accounts, you're at serious risk. Those claims are either going to be settled at deep discounts, locked in frozen systems, or forcibly converted to cash. And in each of those outcomes, you lose. So what do you do now? What's the immediate plan of action following the 3-4-7 a.m. event? Here's how to respond. Step 1. If you're long COMEX silver futures, you need to act fast within the next 24 hours. The COMEX is still frozen as of now. But when it reopens, likely tomorrow or Monday, there are only two possible scenarios. Possibility 1, COMEX reopens in standard fashion. Trading resumes. You get a brief window, maybe hours, to exit your position before they pull the plug. If that happens, get out immediately. Lock in your gains if you're in the green. Take the hit if you're not, but close the position. Because if you stick around and force majeure is declared later, you'll be handed $75 cash for something worth $150. Don't wait for that. Exit while you still can. Possibility 2, they reopen with tight restrictions. Only liquidations allowed. Cash settlement announced. New trading limits imposed. If this is how it plays out, then you're stuck. Your fate is in their hands. You'll get whatever they offer, and there won't be anything you can do about it. Second, if you're bullish on silver, if you want real exposure, move immediately to physical. Do not hesitate. Call dealers now. Take whatever they have in stock. Yes, prices are steep, $158 at most U.S. dealers. That's $87 above Friday's COMEX close. Pay it. Because 2 weeks from now, it might be $200. A month from now, $300 isn't unrealistic. The COMEX price no longer matters. The exchange is frozen. Goldman stopped quoting. The paper system is broken. The physical market is the only functioning market. That $158 price tag, that's the real number. That's the cost of acquiring actual metal, not a promise, not a contract, real silver. And if you wait, if you delay, prices will go higher and supplies will tighten. Third, if you're in SLV or another silver tracking ETF, understand your exposure. SLV claims to be backed by physical metal, but that metal is held in vaults controlled by JP Morgan. And JP Morgan stopped quoting this morning. If they can't price silver, how can they support redemptions? Authorized participants looking to redeem SLV for physical are going to run into the same problem as COMEX longs. JP Morgan would have to buy silver at $150 to cover ETF shares priced around $71. That's a massive loss. So what's the likely outcome? SLV suspends redemptions. The share price disconnects from NAV. Panic follows. Get out of SLV. Sell now. Take the cash. Buy physical. Fourth, monitor the COMEX reopening announcement like a hawk. When they publish the official notice, look closely for coded language signals that the game is changing. Temporary modifications to contract specifications equals rulebook rewrite. Enhanced risk management procedures equals sky-high margin calls and trading limits. Alternative settlement options equals cash settlement is coming. If you see any of that language, it means COMEX is abandoning physical delivery. Act accordingly. Fifth brace for premium escalation. Today you might still be able to buy silver at $158. Next week that number could easily hit $200. By the end of the month, $250 or more is very possible. Inventories at dealers will vanish. Some will stop taking new orders altogether. This is just the beginning of the physical supply crunch. Refineries can't keep up. The mints are already rationing supply. And with each passing day, with the COMEX still frozen and Goldman remaining silent, trust in the paper market erodes further. Meanwhile, demand for physical metal is exploding. We are at the very beginning of a premium supercycle. Here's how this likely plays out over the next 3 months. Week 1, the current week COMEX issues a notice trading to resume Monday, but with temporary safeguards in place, higher margin requirements, tighter position limits, possibly even hard caps on daily price movements. Trading reopens, but its disorderly volume is anemic. Spreads are enormous. By Friday, several major players begin quietly exiting. Goldman says they're reassessing commodity exposure. JP Morgan releases a statement about capital reallocation. Translation, they're running for the exits. Weeks 2 through 4, COMEX liquidity continues to deteriorate. Fewer trades, open interest dries up, traders are bailing. Physical premiums jump past $200. Dealer websites show 4 to 6 week delivery windows. Some dealers stop accepting orders altogether due to lack of inventory. Mainstream media picks up the story historic volatility in silver. The coverage minimizes the implications, but the public is starting to notice. Reports of physical silver shortages become more widespread. Confidence in paper silver evaporates. Month 2, the COMEX drops a bombshell. Scenario 1, they formally declare force majeure. All open contracts are settled in cash at a price they determine. Scenario 2, they announce a transition to cash-only settlement for silver contracts going forward, no delivery mechanism, period. Either way, the paper market ceases to be relevant. It's game over. Meanwhile, physical silver continues to trade. Prices now sit in the $250 to $300 range, and they're still climbing. Month 3, a new market structure emerges. The old COMEX system is effectively dead. There may still be a paper benchmark floating around, but it's untethered from reality. A synthetic number used for legacy bookkeeping, not actual price discovery. The real silver market is now physical only. It's driven by dealer inventory, private vault supply, sovereign hoarding, and direct peer-to-peer transactions. The only prices that matter are the ones for real metal coins, bars, and kilo bricks you can touch. At this point, silver settles into a new price regime, maybe $300, maybe $400 plus. Wherever it ends up, it's a complete revaluation from the days before Goldman shut off the machines at 3:47 a.m. This is the blueprint, and we are at ground zero, the precise moment when the most sophisticated player on Wall Street stared at the data and said, "We're done here." Everything that unfolds from this point forward flows directly from that decision. The cascade has begun. The paper silver market is unraveling, and the only thing left standing will be physical metal. Make sure you're holding the real thing, not digital IOUs, not ETF ticker symbols, not exchange-traded bets, real silver, in your hands, in your vault. Because when the force majeure is declared, when COMEX contracts are forcibly closed out at $75 and physical silver is changing hands at $300 or more, those who trusted paper are going to be wiped out. And those holding metal, they will come out on the other side, not just intact but enriched. So choose, and choose now, because the door is closing, and once it shuts, there's no getting back in.